Hello, everybody. Welcome to today's lesson. Today, we're going to be diving into the world of financial statements. Now, I know that might sound a little dry, but stick with me. These documents are super important for anyone running a business or looking to invest in one. So, let's start with what are financial statements? Well, financial statements are like report cards for businesses. They tell you how the company is doing financially and help you make smart decisions. So, what's an income statement? So, the first type of financial statement we will be looking at is the income statement. This is also known as the profit and loss statement. This document shows a company's revenues, money coming in, and expenses, money going out, over a specific period, like a quarter or a year. The main goal? To figure out whether the company made a profit or loss. So the key terms are revenue, which is the total amount of money earned from the goods or services, cost of goods sold, which is the COGS, the direct costs of producing those goods or services, gross profit, which is the revenue minus the cost of the goods you needed to produce. This basically says that what's left after paying for production costs. Then you have operating expenses, and then you have operating income. Operating income is the gross profit minus operating expenses. And our operating expenses is the cost of running a business. So, for example, imagine a small bakery that earns $10,000 in a month from selling cakes. It costs them $4,000 to make those cakes. They spend $3,000 on rent, salaries, and utilities. So their gross profit is $6,000, operating income is $3,000, and after other expenses and taxes, the net income is $2,500. So now let's look at what a balance sheet is. Well, a balance sheet tells you how a company's financial position is at a specific moment in time. So the key terms here are the assets. These are the things that the company owns, like cash, inventory, or property. Liabilities is what the company owes. Equity is the owner's share of the company after all the debts have been paid. So the balance sheet equation is assets equal to liabilities plus equity. So for example, a small retail store has $5,000 in cash and $10,000 in inventory and $15,000 in property and equipment, totaling $30,000 in assets. They owe $8,000 in bills, which is the liabilities, and $7,000 in long-term debt. The owner equity would be $15,000, which is the difference between what they own and what they owe. So now we'll be looking at cash flow statement. Well, cash flow statement tracks the flow of cash in and out of a business over a period. So the key terms are operating activities. This is cash from day-to-day business operations. Investing activities, cash used for buying or selling assets. Financing activities, which is cash related to business, financing the business, like issuing shares or paying off loans. And then, for example, a manufacturing company receives $20,000 from customers. So that's your operating activities. Spends $5,000 on new equipment, which is the investing activities, and repays $3,000 of loan, which is the financing activities. Therefore, their net cash flow for that period would be $12,000. So how do you read and interpret a financial statement? Well, you want to compare periods. Look at statements from different periods to spot trends. Then you want to analyze ratios. Use financial ratios to evaluate performances. Then you want to look for red flags. Keep an eye out for signs of troubles like decreasing revenues. So if a company's income statement shows a consistent decline in net income over 3 years, its balance sheet reveals growing debt, and its cash flow statement indicates negative cash flow. These are red flags. They might be struggling financially. So the importance, well, they help you with decision making. They provide the info needed to make smart business decisions. They offer transparency to investors, creditors, and stakeholders. They help ensure the businesses flow following the rules and regulations. They also allow businesses to evaluate their financial performance and plan for the future. So financial statements are the backbone of understanding a company's financial health. They help businesses make informed decisions and attract investors and plan for the future. Whether it's the income statement, balance sheet, or cash flow statement, each provides a unique view into how a business is performing. By learning to read and interpret these documents, you'll be better equipped to manage or invest a business successfully. Thank you for watching. If you have a question, please don't forget to comment.